All right. Hey, good evening, everyone. Welcome to the Hurley Investments Market View Commentary for Monday, the 5th of October. And all I'm going to say is today is going to be interesting. And today I'm going to share something with you that my 26 to possibly 30 years, if you want to count 401k and stuff, but my 26 years of experience just learned. I am going to shock you, and it's absolutely unbelievable. As we go over last week, S&P index rose 1.5%. It's its first weekly advance since August. And the funny thing is, real estate, financial, and utilities led the sector going up. I'm shocked at real estate because, in all honesty, real estate's going under, which are directly affecting financials. And utilities, when I think utilities, they're basically broadly run by the oils. And I just think utilities fall into the energy sector. I'm a little surprised. S&P was down 4%, still up 8.5% for the quarter, but was only up 3% overall for the year. Not much to really speak of. There's your review. Feel free to review it and to enjoy it. All right, here we go. Mark Twain said there are three kinds of lies: lies, damned lies, and statistics. And again, I think with the market makers, and I'm primarily going through this because the statistic that is most commonly used is average returns. And I am going to go over some average returns with a couple individuals here on American funds. And they really had a bad rap back in the day. When I say back in the day, early 2000s, most people are trying to get away from them. Yet there's been a resurgence. There's been a huge resurgence into American funds, which are mutual funds. And I honestly have went back in time and called someone that I knew that had them, and they can literally report over a 10-year period of time over 100% return, and his fund hasn't grown at all. It's absolutely flat. And I said, are you sure? That seems far-fetched. That seems so far-fetched. I'm shocked. And I think the biggest problem in my industry is we give out these average rates of return, which the market never averages up in a straight line. It's a variable return. These returns don't count commissions, fees, rebalancing, the losers they pulled out. It's fictitious bullshit, and it shocks me. So I threw in a fun statistic. Bezos himself is worth enough before he could buy Viacom, Ferrari, the NFL, which is all 36 teams basically, right? Top 3 European sports teams, and still have $7 billion left over. It is unbelievable. That is a statistic that shocks me. And the funny thing is, that is the statistic that people will go to say that the world isn't fair, that the world is wrong, that no man should have that much money. I mean, he risked everything, and he gave up his family and his marriage, to be honest with you. I'd like to manage 100 million. It would give me some generational wealth, but he's earned it. For my whole life, people have said options are risky. And as I've heard options are risky, I know there's some options that are risky. But with that said, Today I am going to explain to you exactly why options are risky and how you can lose basically everything because of options and because of credit spreads. So with that said, give me a quick second. I want to see if I can't bring this in. All right, so here we go. On 8/28/2020, I entered into Tesla bull put spreads on Robinhood.com. Only 2 contracts, field of credit of 280. And just to give you a heads up, 280 on 2 contracts, 10 for 1, you're probably looking, or 5 for 1, right? $5 spread. You have a $2.80 credit, right? A $2.80 credit. Nope. $1.40. There are 2 contracts. You have a $1.40 on a $5 spread. What do you think? Those that do credit spreads, what do you think? It's a 3-to-1 risk to reward, right? A little worse than that, but not by much. 3.3 risk for 1 reward. But what do you think? No strike prices yet, but it was placed in the money. In all honesty, it's probably a 2050, 2045. But I said in the money. Bull puts have to expire, so it's out of the money. I mean, you're $50 out of the money at this point in time. $50 out of the money. $1.40 for a $5 spread. Is that a yes or a no for you credit spread traders? Good trade, good credit. I know some people that are doing only 40 cents, 50 cents. No con, there we go. William, great. So you like that, William. Awesome. All right. So there you go. There's your bull put, right? You split 5 for 1 and your 2 contracts goes to 10 at a 410, 409. Which means your $1.40, let's see what it comes out to be. $1.40 divided by 5. You now have a 28 cents credit for $1 of risk. No brainer, right? On 9/1, Tesla trade up to 502. So we're talking about being way in the money. 0 cents. And 11 times he tried to sell the spread. What was the mistake? What was the mistake on this right here? Tried to sell it 11 times. What was the mistake? Sell at market, definitely. But I think there's another mistake. Buy back the short leg first. Bingo. That's how I would have done it. Buy back the, well, actually, let's say, first of all, right? First, I would have had 2 cent debit. Even though it's 0, I would have had a 2 cent debit. Excuse me. And I would not have done 1 cent. Why would I have done a 2 cent debit on a 0.00 spread where you have no volume on it. So why would I do a 2-cent debit to buy it back? Bingo. Have to make it worthwhile for the market maker. Mod, you nailed it. Then if I wasn't getting filled, close the short put leg. Why? Why are you closing the short put leg? Maximum risk, you'd put the stock at the strike price, bingo, right? That is your obligation. You're getting out of your obligation. And even if it was at 0, I probably would have just put 2 cents for that side of the leg. But on expiration day, Tesla traded between $3.72 and $4.28, closed at $418.32. That is $8.32 in the money. $8.32 in the money. And I thought I won the trade. Is there anything there that stands out to anything? Anybody there that would look at that and go, oh, Kevin, you screwed up? Anything there that you guys are seeing that I would miss? I'm good. If you think I'm good, tell me I'm good. Because I think I would be good too. I would plain and simple be, you know what? I'm good. I'm 100% good. I'm $8.32. Nobody is going to go and exercise a short and lose $8.32 after the market closed. So let's talk after hours trading. Typically, how long do you have for aftermarket hours trading? Really? All that work and it's not going to show it to me. You actually have like an hour and a half. And the markets are open up like 4 hours after market hours. But you have an hour and a half. And of course, this isn't going to show it to me. That bugs me. So here's the short answer. Friday afternoon on September 4th. There it is, closed it at 418.32. Friday afternoon, we got some news that things were not looking good. I wonder if I could bring it up. Tesla. What if I could do 04? So actually I want to do the 6th, and I want it to end on the 7th. That did me no good. Let's do the 20, 4th, I want it to end on the 7th. And I want to go minutes, weekly. Not helping me. It's important for me to show it to you, though. I'm not finding it. Okay. Well, here's the short answer. And here is where you need to understand. On credit spreads, after market hours, a clearinghouse can send in short orders to your broker and have them filled. I was trying to find, and I haven't been able to find it yet, but I do know Tesla started to fall after hours. And plain and simple, this poor person was absolutely hosed. Here is the explanation from Robinhood. On September 4, 2020, Tesla closing regular market hours. At this time, you were held out of the money. Later that day, during post-market hours, price of Tesla moved, which may have made part or all of your short side options be in the money. Overnight Friday 4th, the market closed. You informed on his corner that your short position did not expire worthless. He was basically assigned 600 shares. Assigned 600 shares. Take one guess where Tesla opened up Tuesday. Take one guess, just a simple guess, where it opened up Tuesday for this poor individual. Any guesses? Oh, not only lower, He was filled at a margin price for that share, for those shares, which were quickly sold. He now owes 137K to Robinhood. So my comment is that doesn't make sense. Let's come in, let's talk about it. And here's what I found out. Well, we submitted it, but it was too late to submit your long puts because the clearinghouse and the computers, even though it's a spread, even though it was a spread, they see the positions individually because there are millions that go back and forth and go through. It's amazing because here's the part that gets me that I really tried to help them understand. By the time we received notification that your short was assigned, it was past the cutoff to submit exercise request on your long put position. So that is an internal issue. That is a Robinhood issue. So as I sat through FINRA today, as I sat with Robinhood, my comment was, I'm sorry, Robinhood did not show their fiduciary responsibility. They also showed preferential treatment. And boy, you should have heard Robinhood throw a shit fit. And the preferential treatment was given to all the other people that somehow did get their long puts exercised, because there were others within there, but this gentleman did not. And he's got a small account with Robinhood. I mean, let's face it, you're trading with Robinhood, it's a ridiculously small account. But if you do the math, right, 409 minus 356 is 53 times 600. It's actually only 31,000. So I need to make a Robinhood brokerage. There we go. So plain and simple, I said, hey, he had a long position there. Well, when we picked it up after hours, it showed it was expired. Okay, well, now you're showing preferential treatment to a short option over a long option. Both were there. If one expires, they both should expire. Well, that didn't happen here. And my comment was, no shit. But think about it. Think about it in plain English. What you expect someone to do on a short position that is $8.32 in the money is that after hours, you expect them with that first hour and a half to click the exercise button or calling you to exercise a long put position. Which, if you listen to what I'm going to tell you here, you're going to sell stock that you don't own. So I sat there with FINRA and I said, all right, you expect me to tell my people to create a naked short position where you have the right to sell your stock at a certain price for a certain period of time that you don't effing own in case you might get assigned a short put option, because after hours it's gone in the money. Where the hell is your goddamn margin agreement that protects people? Why on God's goddamn freaking green earth would you expect someone to go naked short to try to protect themselves from a short put? How the hell could you allow a brokerage house to do this? But if you look at all the small print, that is the risk you take with options. So my next question is, show me the stupid mother effer that said, I want to lose $8.32 and exercise a short, and have a short put position, I guess it's got to be a long, yeah. So show me the position. Show me the clearinghouse order that says some dumbass exercised a long put to lose $8.32 when the market closed. Well, then they tried to make up some bullshit that, oh, you know what? Maybe it was already in the money. Maybe they had an 810, 820 where they were exercising, their 410, 420. So maybe they're exercising their 410 long against their 420 shorts. To where I came and said, Mr. Dumbass at Robinhood. Well, if that was true, then they were already covering a short position. Why the hell would you put a second position in play? Your options only cover one goddamn position at a time. Which actually leads me to believe that plain and simple, they couldn't close out their own position and they stuck it to them with treasury stock. Because you now have some options that are expiring with nothing there. There's always supposed to be another side of the option, right? But we were just proven that that's not necessarily true. Because you can't have one option expire, but apparently not your other. I went the rounds with Robinhood. I went the rounds with the FINRA. Move this up the chain to FINRA. And the short answer is every dumbass that you've ever heard say, I want to get paid to get, play in the market has been either a dumbass or been on the brokerage side so they have someone to stick it to you. Anytime you have heard someone tell you how these spreads and shorts make it safe for you, don't have a goddamn clue what they're talking about. And this is why at Hurley Investments, we use the long put option to act as insurance. We rarely, if ever, keep short puts in play through expiration because there's too much risk. If we have a short call where you're obligated to sell the stock, we always already have the stock in place. And we're okay with losing our stock for a profit. Shocking to learn the small fine print is there to protect the brokerage houses, the clearing houses, and the money makers, not the individual traders. to fight your credit spread if you don't close it and it moves after hours for the possibility you might get assigned, you have to create the riskiest position available and go into a naked short position by assigning your long puts or exercising your long puts, where you have the right to sell shares of stock that you don't own. So for all of those that have had credit spreads in the past, that have been told, I need to get paid to play in the market, that think your brokerage house is there to protect you, it's a crock. $8, 2% in the money, and you're not protected. $26 years, 31 total in the market. And I never knew that. So from saying this, because those of you that are trading credit spreads, watch your ass. Because you could be in significant trouble with a brokerage house whose fiduciary responsibility is to protect you, who puts all these limits on your accounts for margin and what you can do and can't do, and won't honor any of it in this type of scenario. I'm pissed. I'm shocked. I don't understand. And the only way that this could truly happen, because after market hours, I thought you couldn't even call in, but it is true some people can do it. But again, even if you exercise to protect yourself, it goes against your other position you have there. It doesn't go against someone else's, because then you've got that open position there. I don't get it. Where will markets end this week? I'm going to follow the trend, and I'm going to go higher only because we're now bullish on our index. We're getting our crossovers. For those of you that are new to options, I'm sorry if it scares you. It shouldn't, not the way we do it, but I am trying to protect other people that do trade options on a more consistent basis. And our NASDAQ is now moving bullish. Where the S&P end October, I'm going to tell you it'll be down 5%. I'm just saying that because we made up we lost 4% last month. We were up 9% in August. That was artificially inflated. We'll probably lose another 5%. And as I told you before, the gains will come at the end of the year after our election. God only knows when that's going to happen. Earnings are banks primarily this week. Citigroup, BlackRock, Fastenal, J&J, JP Morgan on Tuesday. Goldman Sachs, US Bank Corp, United Healthcare, Wells Fargo, Alcoa, United Airlines, Bank of America, Schwab, Morgan Stanley, Western Boot Alliance, and Intuitive Surgical on Thursday. Bank of New York Mellon, Schlumberger, and VF Corp on Friday. We have Fed minutes that should boost us on Wednesday. Retail sales and Friday will move our markets based on our economic reports. Monthly options expiration are also on Friday. Nothing international that I saw that I would worry about. There's our list for earnings as earnings are coming up. If you see an EST, that's an estimated date. BMO stands for before market opens. AMC is for after market closes. Not a whole lot has come through and confirmed their earnings just yet, but we are protected through our banks. Banks should most likely do pretty well. They really should. They have been doing well. So not much to worry about, but we'll go through Bank of America and JP Morgan for this week. What moved Baidu before we had our coronavirus scare was right here, another value at $2 billion on a part of their business. Baidu should be at least $245 a share. A couple risks keeping an investor up at night for plain simple for his bull market. And his first concern is around the election, obviously, and the second one is the spike in the coronavirus. That's it. Those are the two risks. It's kind of like, and it took you this long to figure that out. And pretty interesting. I always like Piper Sandler. With 1 month until the presidential election, the analyst plots S&P 500 key levels. Just something for you to look at for how low our markets could go. And interesting, I don't understand how the market is now pricing in a Biden win. It's something that's bullish. Higher taxes, more regulation does not help the stock market or companies. Yet I've got some dummy at Bloomberg that's talking about how a Biden election win is bullish for the market. Once again, I call BS. Another idiot that's trying to get 15 minutes of fame. Any questions you guys have for me? I know I have been on one today. I told you it would be entertaining, but I am shocked at how poorly the markets are set up to truly help and protect an individual. They're not. If your advisor's not doing it, if your advisor's not on top of things, and most advisors, let's face it, they stick you in something and let it sit. My hell is the risk astronomical. That just goes from shorting positions to arbitrage. It's just, it is absolutely scary as all get out. Do I know about NetEase? I thought NetEase did like a 4-for-1 split. So I will tell you right now, I used to trade them all the time, but I'm pretty sure NetEase went through a 4-for-1 split, and that's why they're down. Yep, they went through a 4-for-1 split, Ida. I remember there was talk about it, but that's what happened. NetEase went through a 4-for-1 split, and that's why they dropped. And that's why they're now cheaper if someone would choose to get into the China gaming. And since we don't trade a whole lot of international, and I worry about their October 2nd, 4-for-1 split. There it is. Maybe did a 5-for-1. Did a 5-for-1 split. But it's right there. Good noticing, Ida, but I don't trade that one much. Any other questions? Mike, Jeff, Rich, William, Mary, Dave and David, Abraham, Bill Brander, Ida, you got to get out of those credit spreads. All those dummies that have talked you into trying to beat them for all those years, just need cheap small accounts to screw people. When I say cheap small accounts, I'm talking about 5 million or less. So do be careful. Do be careful and understand the risk. Maud, you seem to have understood as you type in your comment, so I didn't include you in that group. But man, shocking. Shocking as I went to one other individual. I got another individual that's at 31 that I use in this example, and someone else that's at $137,000 on like a $50,000 account. I don't know. I think they go to collections. I think you're screwed. I don't know how to fight this. If you don't get help from FINRA, you don't fight it. You go to collections or you pay it. And that's the risk. Guys, have a wonderful evening. I'm sorry I come across a little frustrated or angry. I'm a little frustrated and angry. Be careful. Be careful because they're out to get you. Guys, have a good evening. I appreciate your time. I look forward to seeing you tomorrow, and have a good evening. With that said, Jeff, I'll call you and give me top of the hour. Goodbye.